Let me ask you something. That hot stock tip your uncle gave you at the last family barbecue, is it a secret gold mine or is it just, financial garbage? We're going to answer that today. And we're going to tackle an even bigger question. Is the stock market a perfectly rigged game that you just can't win? Or are there cracks in the system? Cracks that let the really smart money get ahead? Is it a perfect machine or a chaotic casino? Let's dive in. I'm your Dean of Dollars, and today we're performing a full-blown forensic audit on one of finance's biggest, most foundational ideas. You know the one. It's the theory that tells you to just buy an S&P 500 index fund and, call it a day. But is that really the whole story? Let's find out. All right. First things first, we got to crack open the textbook. We need to break down the core theory that gets taught in every single Finance 101 class, because this is the foundation for our entire investigation today. So it's called the efficient market hypothesis, or EMH for short. And on paper, it's a beautiful idea. It basically says the market is this hyper-intelligent, all-knowing machine. Every piece of news, every earnings report, every whisper of a rumor, bam, it's instantly baked into a stock's price. So what does that mean for you? Well, it means there are no secrets, no hidden gems, and absolutely no undervalued stocks just waiting for you to find them. This quote from Burton Malkiel just nails it. The second you hear about some revolutionary new product, guess what? The market's already heard it, and the stock price has already moved. So that hot tip from your uncle about a sure thing, I'm sorry to say, but by the time it got to him, it was already ancient history on Wall Street. The price already reflects it. And that, right there, is why most amateur stock picks end up going absolutely nowhere. Okay, so that's the theory. A nice, clean, perfect market where everything makes sense. But what happens when the very guy who won a Nobel Prize for this idea, Eugene Fama, publishes research that basically blows a giant hole in his own ship? Yeah, things are about to get interesting. And this is it. This is the paper that sent absolute shockwaves through the entire finance world. Back in 1992, Eugene Fama and his colleague Kenneth French dropped this little bombshell, and the irony is just, it's delicious. The literal father of the efficient market hypothesis was about to hand a loaded weapon to everyone who believed you could beat the market. So the old model, what you see on the left, it was all about this concept called beta. The idea was super simple. The only way to get a higher return was to take on more risk by buying riskier stocks. End of story. But what Fama and French found was just stunning. Over on the right, you see two new factors that were actually way, way better at predicting a stock's future return. First, how small a company was, that's its size. And second, how cheap it was compared to its assets. In other words, its value. Now, just look at this chart. Look at the raw data right here. That number at the very top, that's the bombshell. From 1963 all the way to 1990, a portfolio of small cap value stocks returned an average of 1.92% per month. Now, compare that to the measly 0.70% for small growth stocks. That is a massive, massive difference. And according to the simple efficient market hypothesis, a difference like that shouldn't even exist. This proved that how you invest by focusing on small, cheap companies mattered a whole lot. Okay, so we've established the market isn't perfectly efficient when it comes to a company's size and value. But what about momentum? Let's look at a strategy that seems to just print money when everybody else is losing their shirts. This is even more evidence that the market is far from perfect. All right, here's a dead simple strategy. It's called trend following. It doesn't care about earnings reports, who the CEO is, or what the company even does. Nope, it's purely mechanical. You just track two moving averages of a stock's price. When the short-term trend crosses above the long-term trend, you buy. And when it crosses below, you sell. You can even go short, which is just a fancy way of betting the price will fall. It's a pure bet that whatever's been happening is gonna keep happening. Now look at this chart. This is just, it's wild. Check out 2008. The S&P 500 got absolutely annihilated, right? It dropped 37%. The entire global financial system was basically on fire. And yet, this simple, mechanical trend-following strategy, it returned a positive 44.7%. It was having its best year ever while the world was financially imploding. In a perfectly efficient random walk market, that is simply not supposed to happen. No way. So if the market isn't this perfect, efficient machine, then what is it? It's clearly not a perfect computer, but it's not pure chaos either. We need a better model, a more realistic one that actually accounts for the messy, emotional, and sometimes irrational creatures who are running the show, us. And this brings us to a much, much better model, the adaptive market hypothesis.
So forget thinking about the market as a supercomputer. I want you to think of it as a jungle. It's a complex ecosystem filled with different species, right? You've got your day traders, your hedge funds, your retirees, all competing. And in this jungle, the goal isn't to be perfectly rational. The goal is to survive. It's not survival of the most rational, it's survival of the richest. And in this jungle, strategies that work, like focusing on value or momentum, can thrive, at least for a while.
So here's the crucial idea. Market efficiency isn't an on or off switch. It's not a binary thing. It's more like a dimmer switch. It's a spectrum. A market can be more efficient or less efficient, and it all depends on its structure and, most importantly, how easily information can travel between all the players in the game. And this image illustrates the point perfectly. Over on the left, you see a well-connected market. Information flows freely, like water through a river. That market is going to be highly efficient. But look at the market on the right. You see that problem? Information has to pass through just a couple of nodes to get from one side to the other. That, my friends, is an information bottleneck. This could be a niche industry where only a few analysts are covering the stocks, or maybe a foreign market where news just travels slowly. This is where you should be seeing flashing red lights, because these bottlenecks create temporary, exploitable inefficiencies where prices can get totally out of whack.
Okay, we have been through a lot of theory, a lot of data. So what does this all actually mean for you, the investor? Let's distill all of this down into a brand new 101 level playbook for how you should think about the market. So let's put it all together. Here is your new playbook. First, the idea of a perfectly efficient market. It's a great starting point, a useful theory, but it is not reality. It's not an unbreakable law. Second, those factors we talked about, size, value, and momentum, they aren't just lucky flukes. They are persistent anomalies that really challenge that old, simple model. Third, and this is crucial, remember the market is an adaptive ecosystem, not a physics equation. It's a jungle out there. And finally, inefficiencies are real, and they often pop up in those information bottlenecks where the flow of information is poor. And all of this leaves us with a final, pretty provocative thought. Maybe the whole goal isn't really to beat the market with some genius stock picking. Maybe the real game is about understanding these deeper dynamics, the factors, the trends, the bottlenecks, and simply playing a smarter game than everyone else. That's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the lights on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.